Hello and welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting, and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going to continue talking about the impacts of COVID-19, but we're going to focus specifically today on IAS 12, which is income taxes. And to help me through that, I'm joined by Mr. Tax. He's not only known as Mr. Tax, but he was also the presenter of PwC IFRS Talks. So we're very lucky. Welcome back, Dave Walters.
Thank you very much for that introduction, Ruth. Mr. Tax is not a title I've had before, and I won't necessarily be putting it on my business card, but thank you anyway. It's good to be back.
Oh, it's nice to have you. This is very exciting. Okay, so you have to help me through this. We're back in IAS 12. So one of the first questions we always get in accounting is sort of a scope issue, i.e. are we even in IAS 12? And the hard thing I think with this is the governments all over the world in response to COVID-19 are doing lots of different things. And one of those things could be, offering tax holidays, it could be lowering a business rate, so many different things. And how do we even decide if all of them do fit in IAS 12 or could they go somewhere else?
I mean, that's a great question to start with. And typically what we would do is if you've got assistance from the government, you might start with looking at IAS 20, accounting for government grants. And there actually in the scope of that standard, it kind of helpfully sets out that it deals with the accounting for government assistance and government grants, but excludes from the scope of it assistance that's provided in the form of benefits that are available in determining taxable profits, such as tax holidays and the like. So we have kind of a specific scope out of IAS 20, and it tells you to go and look at IAS 12. So if we do have things like a tax holiday, for example, or a temporary change in rates, then that's likely to be in the scope of IAS 12. So we can look at IAS 12 as our starting point.
Okay, so once we've wheedled through probably one of the hardest questions is like, what scope are you in? And we know we're in IAS 12. I was going to say IAS 20. We know we're in IAS 12 taxes. How do you actually, how do you account for a change in rate or a tax holiday?
We apply the normal principles of IAS 12, which basically stresses that to apply a change in rate, you need to have had substantive enactment. So substantive enactment is, I guess, a process we well know, and in individual territories around the world, you'll have a view as to what point the legislation has been substantively enacted. So in the UK, has it been through, as it's kind of cleared sort of second readings in the House of Commons, but in other territories there will be a legislatory process that goes through and you reach a point of substantive enactment. In many cases what's happened is these reliefs have been given quickly and emergency legislation has gone through, so the gap between the announcement and the legislation being substantively enacted is pretty small, but you can usually find a point beyond which it's substantively enacted and you can account for it. And if that point happens to have occurred just after your period end, then you're into non-adjusting but disclosable post-balance sheet events territory. So that's the key point. If you've got substantively enacted, you can then apply the rate, and you apply that rate to your taxable profits and indeed to your deferred tax calculations if, for example, the rate affects the recovery of deferred taxes in the future.
Perfect. So great segue there. IAS 12, unfortunately, doesn't just cover current tax because that would be quite a nice standard. Unfortunately, it then chucks in a curveball. And we love the deferred tax. I think you're obviously getting all the questions on tax, but I would say one of the biggest things that people are looking at is, your deferred tax assets. So, and you can correct me if I get this wrong, but it's all around, is there probable or will there be probable taxable profits available against which I'm reading this out from the standard or my notes because I would get it wrong otherwise, was against which the deductible temporary differences and tax losses carry forward can be utilised. So i.e. in summary, can you book, your deferred tax asset? Will there be enough profits to recover it against?
That's a key challenge actually in applying this standard, and it's been an area of focus for regulators around the world over many years. What is the evidence that companies have to support recognition of deferred tax assets or losses? So even prior to COVID-19, this has been an area of focus. Clearly, to the extent that COVID-19 has had an impact on the company or the industry such that they're currently making losses where they weren't forecast to make losses, and they've revised their projections going forward, then that needs to be fed into the company's modelling on whether it's right to recover deferred tax assets. And it might be, and we are certainly seeing quite a lot of questions from companies around they previously recognised deferred tax assets on losses and now think that they might need to de-recognise them, kind of adding to the pain, if you like, adding to the losses that have been triggered by the events of the last few months. And there's a big judgment here. So in assessing the profit projections against which losses can be utilized, clearly you'd be looking at, the impact of the crisis now, the likely impact on future projections. So what are industry forecasts saying? Are there signs of recovery already? And we are hearing in a number of sectors that the total lockdown is finishing and there are some signs, green shoots of recovery, but there's a long way to go. It really is having a good rounded look at those forecasts and thinking through all the implications. So it's not just the company and how it might trade, but to the extent that it's exposed to its customers and their financial condition, are there knock-on impacts? So there's a big judgment here, and one of the areas the regulators have said time and time again is where you've got critical judgments like this, then disclosures are going to be helpful, and there's a need to make sure that judgment is updated. There's no doubt that in the current crisis, companies need to be looking at this not only for deferred tax assets that they've currently got, but in the context also of whether they should book a deferred tax asset for the losses that have arisen in the current period.
Perfect. Obviously, you mentioned that the big judgment is really looking at future projections. And we've actually talked about this in quite a few of the COVID-19 podcasts because we see it in fair value, we see it in impairment, we see it in ECL. Like there's lots of places we use projections. Is there anything we need to be careful of when we're looking at the IAS 12 projections?
Well, I think you need to be careful of not looking at these in isolation. So companies are preparing projections, in many cases, a number of projections. So the increased uncertainty that has accompanied the impact of this virus has in many parts of the financial statements led companies to prepare a number of projections. So for going concern, you've got your severe but plausible downside case, you've got a revised base case, you might have other cases in between. And you're using those projections for going concern. You may well be using the weighted average projections for impairment. And I guess the principle to apply here is you should be consistent. So you should use projections that are consistent with those that you're using to assess your impairments, for example, to ensure that the underlying basis is similar. And we've not got an unusually harsh view for deferred tax assets, or indeed haven't an unusually prudent view for recognizing deferred tax assets. The key is consistency. And again, this is an area that regulators have shown an interest in the past.
Brilliant. Thank you. Really helpful. And I suppose when I asked that question, we originally focused on deferred tax assets, but IAS 12 is all deferred tax. So is there any other things people need to think about in other aspects of deferred tax?
Well, to the extent you've got deferred tax liabilities that are going to be available and be reversing, then you can, and indeed you should recognise a deferred tax asset if you've got losses that will reverse in the future alongside those liabilities. So you don't just look at the asset, deferred tax asset in isolation. If you have DTLs, deferred tax liabilities, you should recognise deferred tax assets to the extent you've got those DTLs available, and then look on top of that for whether you should recognise deferred tax assets. So that's one key thing that people ought to think about.
Perfect. And then, depending on when this gets released, Dave, not to give away our timing, but interims, coming up, is there anything specific people should think about in the context of interims and tax?
Well, yes, and this is so IAS 34 requires companies to assess what is their expected income tax rate to be applied to the full year profits, and then apply that expected rate at the half year. So effectively what that requires is an assessment as to the level of forecast profits and the tax rates in the different territories that might be in a multinational group, for example. So that's actually quite a complicated process. Companies, as I say, need to work out what they think their full year number will be, which essentially is dependent on the geographical split of profits or split of profits by a tax authority, the rates that apply to those geographical splits, thinking through, for example, are there issues in a particular territory that mean the effective tax rate there would be higher? So are you knocking up against an issue about being able to recognise deferred tax assets or not? So there's quite a challenge there, and then apply that to the half year. The impact of the virus has made that job, which was already difficult, even harder, because there's a substantially increased uncertainty as to where profits will be. So this is something that companies need to think about pretty early in the half-year process rather than leaving it to late. It may be that actually the starting point is, well, what's my split of profits to date? I mean, what is my effective tax rate based on my geographical split at this point in time? And think through, are there significant things that might change in the next 6 months? So is there a territory that's looking like having a much slower recovery than others, and toning down or adjusting the rate to take account of that lower contribution from that territory? And it may well also be that actually in this particular instance, there's more uncertainty than usual in the rate. There's potentially a wider range that rate could fall within. And then you need to think about appropriate disclosures to alert the reader to that increased level of uncertainty, or the potential range that might apply in the full year when all the calculations are finally done.
Oh, that sounds complicated.
Yes. Yes,
And
it is going to be
and a big
complicated.
exercise for everyone to do. And you mentioned there at the end disclosures and specifically about the rate, but is there anything else people should just be careful of or watch out for in terms of disclosures?
Well, one of the key ones I think for companies in respect of taxes is disclosures of uncertainties. So there has been a big focus in the last few years on disclosures around uncertain tax positions. That is, those issues are unlikely to have got less relevant during this crisis. There may be more uncertainties around as a result of lack of clarity in whether a particular deduction that's being offered under an emergency scheme might actually be applicable to an entity, the lack of transparency around some of the issues, or the lack of progress on dealing with some issues because people have been focused on just keeping the business going. So don't forget the disclosures around uncertain tax positions. I think if you've got an interim report, consider whether there's additional disclosures that need to be given, uncertainties around the rates. And when we've been talking about deferred tax assets on losses, it may be that you've moved to a position where a reasonably possible change in your assumptions will have a material difference on what the asset that you can recognize, and it might have a material impact in the next 12 months, in which case you're into critical estimates disclosures to draw the reader's attention to the fact that that number's more uncertain than it was. So there's a range of potential disclosures for both interims and final annual reports that should be considered as part of the whole wonderful subject of tax.
Brilliant. So much to think about in world of
Yes, indeed.
tax. And as in all the COVID podcasts, I feel like a broken record. We must disclose. But
Yes,
thank you so much, Dave, for coming back.
pleasure.
I'm sure we can think of plenty more to talk about. We miss you in the not studio. We miss
Yes.
you in your home. But thank you very much. And everyone, thanks for listening. There's lots of frequently asked questions you can find on PwC Inform and pwc.com around all the issues for COVID. Plus, we've got our in-depth and industry spotlights. So please do check out our website as well. Thank you very much for listening. Stay safe and happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.